Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers, the only financial advisor that has nothing to sell but themselves, right? 100% fiduciary. We manage our own funds, no commissions, hidden fees, or anything like that. No games whatsoever. Check us out at jazzwealth.com. Well, we also happen to like data here. We like data, we like teaching, we like sharing how things work, how we're doing things. That's just what we like to do, right? Keeps you thinking about asking questions about your dough. And hey, one of the ways we do that, actually, I'll share with you just real quick. If you look over on our client portal here, we've got a Notes from Jazz email that goes out to customers. And you can be a research member as well. If you're a research member, you also get these. And when I talk about liking data, in last week's Notes from Jazz email, we put, hey, we're also entering a slow part of the month, which could explain some of this week's action. Notice that next week for the month of October for the last 20 years has been very small. And I actually shared every single day the average performance of the stock market. I'll share a little bit of that with you here today. But I highlighted to customers, these tend to be pretty quiet days without a whole lot going on, of course, through the middle part, sort of the third quarter of October. And so that's exactly what happened. So we managed to point it out and share the exact performance of the stock market to say, look, the S&P finished flat, basically down 0.5%. It was a small, every single day were small little days there. And so that's one of the reasons we like data. We like to look at things like that. And I promise you what I'm about to share with you here today, you will not see anywhere else. I don't know why, but we like to study this stuff. So I'm going to dive into it. Speaking of data, this week is GDP numbers. Now, there's technically GDP numbers that come out every month. The way they do it is advanced GDP, preliminary, and then final. Yeah, right? It's like complicated enough. So anyways, you basically have a reason to always get some kind of GDP number. Each one of them is released once a quarter, but then since there's 3 of them, then that's technically every month. So it's what we have going on. The class today is not necessarily talking about GDP, but this is known as a market-moving economic number that comes out. And so should you be worried? Should you be excited? Should you adjust? Is there any opportunity? What should you do? See, as fund managers here at Jazz Wealth, we have no choice. We have to know about these things coming up. If we don't, then well, we could get clients in trouble. They could lose more than they should. We might miss out on opportunities. I hate to see that sort of thing. So let's go over here and take a look at this. Here is every single S&P day for the last 22 years on the day that GDP numbers were reported. So GDP is reported before the market opens by exactly 1 hour. Sometimes they mess up and it comes out earlier or later. But anyways, this is it. So average move for the S&P, here we go. We've got every single day going back to 1998. We've got the biggest move and the worst move highlighted as well. Interestingly, both came this year. And so average move for the stock market is next to nothing, 0.11%. Yes, there are outlier days. The median move, of course, is 0.09. There are outlier days and all this good stuff. But in general, it seems like kind of a non-event. We took it a step further, and then a step further, and then 2 more steps further. So hang with me here. Okay, so we've got GDP numbers. We know sometimes it's a market mover, but not all the time. So what we did is we said, well, maybe it's when GDP expectations are either too high or too low, and then the actual results are far away. Meaning we expected X and we got X plus 5 or X minus 5 or something crazy, right? And so what we did is we took the biggest GDP beats and misses to see, does the market respond? Is that where the big days, market moving days are? Well, here we go. These are ranked by the biggest spread. So the biggest beat on record for GDP was actually this year as we're recovering from the coronavirus sort of downturn in the economy. And the S&P barely moved. All right. Back to 2014, right? We've got another beat here. Didn't really move. 2009 it was a big beat. Market went south. That's weird. As you're looking through all this, there's only one real time, I'll give you 2 times where there was a beat and there was a significant move on GDP. I'll give you that third one down there as well. In fact, the average move when there is out of the top 10 largest beats on GDP was negative. Wasn't even positive. Median move, still negative. Average percent positive 40% of the time out of the top 10. Well, we look on the other side, we say, what about the biggest misses? Surely that's where the market does some kind of crazy movement and that's where the excitement's at. No, not there either. Biggest misses here, we've ranked the top 10 of them for you. The markets barely do anything. You got 1 2% day in there and 1 1% day. In fact, the average move is positive. That's weird, right? Meaning expectations were low, or results were lower than expectations, and the markets moved higher anyways. Right? So this is not really a market moving event. And so what we did is we said, well, let's take it a step further. Maybe the big market moving days are the days that something happened in GDP. Let's take the reverse of what we're doing here. So here we go. Here's the top 5 positive and negative days in the stock market on GDP day when the numbers were released. And we said, okay, here's the big movers. Nope, nothing going on there, right? Slight miss, in line, slight miss, slight beat. And we've got this monster day. All right, in line, decline. In line, decline, slight beat, in line, all declines there. Those are the big down days. The truth is the stock market is going to do what it statistically and historically averages anyways. That's it, right? So for example, here we go. I shared the chart with you a minute ago about all of the stock market's average days there. 429, that's historically an above average market moving day. If you take the average performance of every single market day over the last 20 years, then April 29th is historically an outperforming day. Doesn't mean you're going to make 2% on that day. I'm just saying it typically outperforms the 0.18% average that the stock market gains. Okay, no problem, right? So that might explain something. Maybe there was some news or it was some kind of earnings announcement. Okay, March 26th is also an above average day. In fact, they're all above average days. The only one that's not an above average day, I think, is October 27th. And to prove it, we can actually share that with you. So I'm going to pull up the actual data here, and I've highlighted each day. March 26th, April 29th, May 27th. Over here, you got October 27th and 28th. Those were the days on the previous slide. If you look, I color-coded them for you so that you could see. I know this is a little bit geeky, but if you're still watching, I'm glad you're enjoying it. But if we look through March, we have some outperforming days, green being above average and one of the better performers out of the for the month, red, of course, being below average. So over here, we've got March 26th is one of those days that's just above average performing. I don't know why. I didn't look into it just yet. But you've got April 29th, same thing, just happens to be a day that's outperforming. You got May 27th in there, same thing. So the stock market was already going to do well on that day, or at least average a beat that was a little bit better there. Okay, I said we would take it a step further, and that wasn't it, actually. So let's go one step further. We thought, okay, if the market doesn't really do a whole lot, has some days here and there on GDP numbers, maybe the sectors. Maybe if we zoom into the S&P, maybe the individual sectors. Yeah, we like the data around here, so here we go. Hold on tight. Here's what we did. We said, okay, how many times did GDP beat estimates, miss estimates, or come as expected, right? That would be the 0 that you saw on the previous chart. All right, what did the S&P do? Average move, 0.09. If it beat, average move if it missed, slightly better, which you saw on the previous charts there. The best is actually when it comes in as expected. The market just goes about its normal historic statistical move anyways. So then we looked at every single sector and we said, well, let's just go through. So when GDP beats on expectations, financials are actually the best performing sector. Now, that's pretty cool. Energy happens to be the worst performing sector. When it misses on expectations, materials averages the best performing sector. That happens 41% of the time. And, oh, we got to go this way. Something happened. There we go. Utilities are the worst. When we're in line, it's actually communication services. The worst performing sector is consumer staples. So then we went through and said, okay, let's look at each individual sector. What's the best gain that it's ever had? What's the worst loss it's ever had? Utilities ranks the best there for the biggest gain, no matter what, on GDP day. And financials ranks as the worst performer. So it's just, I know it's a lot, right? I'm throwing all this stuff out there. The bottom line is this is research that we had to do anyways. We were looking to see, is there an opportunity? Is there an opportunity during election season? Is there a reason to be worried during election season? GDP results, advanced GDP results, and earnings season. We're in the thick of earnings season. So as fund managers here, we get to share that with you. That's something that usually we put on our research site. You can go to jazzwealth.com/research. At the end of this video, I'll play a little something for you. But that's the kind of thing that we look into. So we're not like that typical financial advisor that's like, sock away a whole bunch of money for retirement and you'll be just fine. That's a horrible answer. We like to look at the actual details of all the investments, your plan and everything like that. So I hope that helps. If you're still with me, you like data just as much as I do, and I appreciate that. So let me know below. We could do this with anything. We could really go through any sort of metric, any economic indicator, any stock market day, you name it, we can cover it. So Let me know. What do you think? What would be an interesting study to check out? You guys have a great rest of your day. Thank you for making through that. If you thought this video was something else, I apologize. That's how we roll around here. Enjoy.